The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon from Melbourne, Australia. This is Graham Critchley speaking. I'm the convener of PIGS, which is an acronym for PXUPA Investor Group Supporters. Most of you will already know that PIGS is a volunteer investor action group that has been proactively representing the interests of all hybrid holders since January 2012. It's been a busy 2 weeks since we last convened. Finally, the board has had a change of heart. For too long, the popular view among ordinary shareholders was the hybrids are a $285 million interest-free loan, followed by whoopee, or let the hybrids hang out to dry or capitulate to a lowball offer. That's been the popular and grossly misinformed view. Without preempting my colleagues, who will be speaking later, resolution of PaperlinX's capital structure will only occur when three things happen. One, the board stops treating retail hybrid holders like fools. The board should note that not many shareholder activist groups are as doggedly persistent as PIGS. Two, hybrid holders accept a reasonable but not unconscionable haircut. And three, ordinary shareholders accept a severe dilution as presently we, that is the PIGS, believe from detailed enterprise value analysis that the ordinary PaperlinX shares are worth next to zero in the absence of a capital restructure. Anyone who understands business and balance sheets has known this for a long while. All PIGS has done is make it public for retail investors, and by that we mean the mums and dads who stumped up $100 for each hybrid back in 2007. Today I'm joined by two colleagues, Paul Waterstone and Simon Oaten, who are both well-credentialed financial analysts. But firstly, a correction and clarification to webinar 1. This is an important clarification for the technically minded only. Dare I note that we always like to be factually correct and thus impose this discipline upon ourselves. First, some housekeeping and Q&A. You should be aware that we'll be recording this webinar and uploading it to the PIGS website and YouTube soon. And some basic housekeeping matters. At the end of this presentation, we have allowed time to respond to your questions. Feel free to lodge them during the webinar. And post-webinar, if you have questions on any topic, it's best to post them to the PIGS blog site so we can collectively improve our knowledge. Today's webinar involves looking back on financial year 2013 and most importantly, looking forward. The results analysis and financial forensics will probably be the most detailed public coverage of PaperlinX's financial results you'll ever see. Why? Because Australian brokers' coverage of the company is dropping off each year. After all, it's now a very small company. Also, today we present the first definitive public statement on the potential scrip offer for the conversion of hybrid PXUPA to ordinary shares. I can assure you it will be very interesting for ordinary shareholders and hybrid holders alike, because we are all in this mess together. I say that again, we are all in this mess together. This is a post-2013 results update and commentary on the potential scrip merger. At the close of the Australian market today, the ordinary shares were trading at 6 cents, which is about where they've been for some time now. And most amazingly, the hybrids closed at $11, which from what I recall is roughly a 6-month high. Dare I suggest something is happening, because Mr. Market is usually very well informed. Today I'll be covering these 5 topics. I'd like to take you back to August the 14th, which was the day following webinar 1. The response we got from the responsible entity was they were still waiting on responses from PaperlinX, and there were no surprises there. And as indicated by Justin on webinar 1, August the 14th was the last day for a response by the RE under its complaints procedures. We reasonably believe that PaperlinX and the responsible entity would both be severely embarrassed by our complaints if they ever became public. So, the simple solution is to divert attention away from past misdeeds by introducing a new plan. And that they did on the 21st. People interested in this matter will realise that PaperlinX issued a market update in relation to the PaperlinX SPS hybrids. It's on our website and also on the ASX, and is seriously, it's a must-read for anyone who wants to know the difference between transparency and compliance. Now, I'm not suggesting that PaperlinX hasn't been compliant, but I'm suggesting it hasn't been totally transparent. And hence, I think a better title for that document would have been PaperlinX Hybrids 101. It tells the story from PaperlinX's perspective in what I suspect is in contemplation of an imminent low ball offer. It certainly doesn't present the whole truth about the hybrids. The problem is that the new plan provides nothing new. It simply has a veneer of respectability because it is being promoted by the board and Moelis & Co. Let me share this with the world, or should I say the those of the world who are plugged in right now. This is no secret, but it ought to be said. We, that is the pigs, have been advised we hold the strongest hand in any PXUPA to ordinary share conversion process. And that is true. Allow me to go into PaperlinX Hybrids 101 in a little more detail. Bullet point 1 is pretty straightforward. Everyone knows that the responsible entity normally has no power to commit hybrid holders. The exceptions are highly technical. Engaging with the RE appears to be another attempt to add respectability to what has been shabby treatment of the hybrid holders by this board over the past 9 months. And I had to laugh when the board suggested that there were some misconceptions. There are many misconceptions about this, the hybrids and our reserve powers. To suggest otherwise is just a joke. However, any attempts to be respectable or transparent are flushed away by bullet point 4, and I'd just like you to read it very, very carefully. The advice from the company is if you want further information, they suggest you contact PaperlinX. But on page 2 is the disclaimer. That's the one at the bottom in blue. I say seeking advice from PaperlinX about the hybrids is like putting Dracula in charge of the blood bank. And thus it has ever been, always with the appropriate disclaimers. Now, before the defamation lawyers get into a tizzy, I'm just stating the facts here. Going back to the time of the original issue in early 2007, Chairman David Meiklejohn was a highly regarded director. He still is. At the time, he had been a director of one of our big four banks since October 2004, and just days earlier, he had been elected president of the Melbourne Cricket Club. It was on 20th of February 2007, to be precise. Now, for our non-resident participants, the Melbourne Cricket Club manages one of the world's iconic sporting venues, the mighty Melbourne Cricket Ground, or MCG. It was home to the 1956 Olympic Games. It's where they conduct the Boxing Day Test matches that our English friends would know so much about. AFL football. It's quite a mecca. It also houses Australia's National Sports Museum. And in December 2005, the MCG was included in Australia's National Heritage List. So what you say? I say this: by including the appropriate disclaimers, the highly regarded Chairman David Meiklejohn actually said nothing about the merits of investing in the PaperlinX hybrid. That's why PaperlinX still claims, over 6 years later, the board and management of PaperlinX have no fiduciary duties in relation to PXU holders. But please contact us if you need any advice about the hybrids. This is just too cute, gentlemen. And before my detractors again allege me of getting too personal, I'm merely publishing facts from the public record for everyone to see. It appears to us that divide and conquer is the current board strategy. Vilification of pigs, and me specifically, is now part of that process, whereas all we do is report the facts. PaperlinX Pigs was tolerated, whilst ever constrained by the highly secretive services and indemnity agreement that exists between the responsible entity and PaperlinX. Few folk are aware of the PaperlinX SPS Trust Investor Advisory Committee, or what we call IAC. Excuse me, I just had a sip of water. It was established as an interface between the hybrid holders, the responsible entity, and thus PaperlinX. It too was constrained by the highly secretive services and indemnity agreement. I encourage you to revisit slide 32 of webinar 1 for more details about this highly secretive agreement. Pigs finally realised there was no way of breaking the cone of silence between the responsible entity and PaperlinX, and thus the outside world, hence the formal complaint lodged on the 4th of July this year. We respectfully submit that if the board wishes to address retail hybrid holders, the appropriate forum is the Investment Advisory Committee, which they, PaperlinX, pay for. It costs a lot of money to run. I heard unofficially the price for the open forum last year, and it was a lot of money. And here's something that's not commonly known. Robert Kay, tried valiantly to attend the open meeting conducted by the Investment Advisory Committee in November 2012. He wasn't allowed because he wasn't a hybrid holder. So there you have it. The Investment Advisory Committee has merit when it suits PaperlinX, but currently it doesn't. Draw your own conclusions. And the plot to divide and conquer thickened today. This morning I received a letter from the responsible entity that said, and I quote, and I'm quoting exactly here, "Dear Graham," that's me because I signed the letter for and on behalf of PEGS, PaperlinX have now provided us with a response to the matters raised in your letter. That is the 12-page letter of complaint of 4th of July. They continue. We will respond to your letter in the 2013 full year accounts for the benefit of all unit holders and expect that the accounts will be released to the market on the 29th of August. So there you go. You write a private and confidential letter and the response will be made public. This is priceless and confirms everything we've previously said about the conflicted position of the responsible entity. I can assure you we have steadfastly kept our letter of complaint private and confidential because we thought it was the right thing to do. Yet the responsible entity is going to respond publicly. That, gentlemen, is a sham. I'd now like to just briefly cover a concept called the streetlight effect, and I'd encourage you to read the opening para there. I'd also now like to share with you a parable about the streetlight effect. The man in this parable wasn't drunk or disorderly. In fact, he wore a nice pinstripe suit. It goes like this. A policeman sees a man searching for something under a streetlight and asks what he has lost. The man says he's lost his strategic plan. So they both look under the streetlight together. After a few minutes, the policeman logically asks if he is sure he has lost his plan here. And the man replies, no, he lost it a long while ago in Northampton. The policeman asks, why is he searching here tonight? And the man replies, this is where the light is. The moral of the story is that PaperlinX simply needs to look at where it's hardest. And there's only two places, gentlemen. Look at the board and look at your balance sheet. It's easy to blame the messenger, and PEGS has been a vocal messenger. But everyone knows the hybrid holders didn't cause the current problems, and we cannot rectify them. And contrary to another popular and gross misconception, we don't seek to destroy the business of PaperlinX. As they say in the classics, this board needs to man up. Remember when we spoke about ethics in webinar number 1? It was slide 36, taken from an internal PaperlinX document, and it was entitled An Ethical Decision-Making Process. Now, it's quite clear that Andrew Price and his supporters made a couple of commercial misjudgments, and I've listed two possibilities on the screen there. Misjudgments or mistakes are made all the time. It's a matter of how we correct them. The ordinary shareholders must face this squarely in the face. There are only two options. Let go of ego and acknowledge past misjudgments, suffer dilution by recapitalising the balance sheet, and get on with life and show us what you can do. Or you can maintain denial and hubris, which means eventual disaster for almost everyone. Now, I say to the board, I say to everyone, let's address the facts, not spin-off fantasy or personalities. We are all in this wretched mess together. Now, having got that off my chest, I now have great pleasure in handing over to Paul Waterstone, who will deliver the some facts about the 2013 results. Over to you, Paul.
Thanks for that, Graham. My name is Paul Waterstone and I'm an investment analyst and professional investor, and I'll be taking you all through the analysis of PaperlinX's 2013 results and financial statements. The 2013 results review will be in three parts. First, we'll go over some highlights from the 2013 results. We'll then go into a bit more detail about earnings per each of PaperlinX's geographical regions. And third, we'll have a look between the lines of the financial reports and the notes and go over a couple of key issues we've identified. And just as a disclaimer here, the working capital calculations you'll see on later slides have been based on first half revenue run rates and using clean trade numbers which take out deferred consideration on asset sales. Full year highlights. FY13 was the first year that PaperlinX did not disclose volume numbers for each of their key regions. And we see by the decline in revenue that a substantial decline in volume must have been the case, given we know prices have actually appreciated for paper. On a positive note, headcount reduction from 4,600 to 4,000 represented a 12.8% reduction and created large cost benefits. The underlying loss narrowed from 27.2 million Australian dollars to 21.4 million dollars, and the second half run rate loss narrowed also to 7.7 million dollars for the half. The tone of PaperlinX's guidance has also changed, and they've indicated they're expecting underlying EBIT to be marginally positive in FY14, which signifies that after tax and interest expenses stripped out, the net result will be another loss. Regionally, significant outperformance in Canada, rationalisation in Australia, New Zealand and Asia now tapering off, with the benefits from that program being realised, and continued losses in Europe and the UK. The two key issues we'll discuss at the end is the actual deterioration in trade working capital, despite the company's commentary that it had improved, and risk disclosures on higher exposure to foreign exchange risk and interest rate risk. Moving across now to regions. In Australia, New Zealand and Asia, the thematic was stabilisation. We estimate the volumes here declined by over 12%. Margin outperformance was not maintained in the second half of 2013, likely due to bad debts and losses of customers such as Geon, as mentioned in our first webinar. We had 199 basis point expansion in percentage gross margin versus FY 2012, which is a significantly positive result, and we see that cost out is more than offsetting the loss in gross margin due to declining sales. And you can see that in the bottom left of the bar chart down there. Strong margin and cost control savings brought about by a 10% headcount reduction have insulated profit against the volume decline. And looking forward, based on the small improvement in gross margin of only 12 basis points in the last 6 months, it now appears that this thematic has played out, and the focus of this region will now be on further optimising utilisation of assets and the cost base. In Canada, as the broking vernacular goes, the result shot the lights out. Despite volume declining by over 7%, we saw significant margin outperformance in the second half versus the first half. A phenomenal result of 4.21% EBIT margin for a commodity product. 115 basis points expansion in percentage gross margin versus FY12, and again we see cost out is more than offsetting lost gross margin. Again, in the chart at the bottom left there, we see the sales decline has taken 2.2 million Canadian dollars out of gross margin, but the benefit of cost out of $7.5 million has resulted in an uplift of EBIT to 13.7 million. Commentary here is that the rationalisation strategy is delivering very well, creating increased profits despite declining revenues. And it's also interesting to note that if Spices Canada were a standalone entity, even taking on its own fair share of debt of the consolidated business, it would be worth more than PaperlinX's current global market capitalisation. And that's the whole of PaperlinX. Now the final problem region of PaperlinX UK and Europe. Here significant restructuring is ongoing, and based on our estimates we've seen volumes declining by at least 13% here. Now this is based partially on decline in the actual markets for paper, but more significantly by Paperlinks losing market share, particularly in the UK. Despite this, we've seen a marginal amount of EBIT margin improvement in the second half versus the first half, and this is being brought about by a small expansion in the gross margin as a result of higher value product and higher margin product being sold. So a positive mix shift there. Now the key and critical issue to note here is that cost out is not keeping up with losses in gross margin as it was in ANZA and Canada. We see here in the chart on the bottom left again that 39 million euros of gross margin was lost by Paperlinks, and the cost out was only $29.4 million. So if you add those two impacts together and apply them to last year's number, you get a worse EBIT impact of negative 27.3 million euros of loss. Now, looking forward to FY14, we're estimating that it will take at least another 200 to 300 reduction in headcount, which is about 7 to 10% of the UK and European workforce to be taken out, and further percentage gross margin improvement will be needed to get the UK and Europe profitable once again. It's also important to note here that when you have regions like the Netherlands who have been restructuring for almost 8 years now, the further restructuring efforts could be in vain and simply throwing good money after bad. In FY14, Paperlinks has announced its undertaking is now to reduce losses as opposed to actually returning to profit. So it may still be another 2 years before Europe crosses break even. Moving now into a couple of the more in-depth issues that we've been able to find by going through the Paperlinks' financials in detail and the notes and the statements. The first of these is trade working capital. Now in Paperlinks' results presentation, two separate presenters both indicated net debt was improved as a result of a release of working capital. However, this is incorrect. This is because the disclosure of working capital items on the balance sheet does not break out true trade creditors from deferred consideration from the sale of assets. If we look at true trade working capital, which is trade debtors plus inventories minus creditors, and strip out the effects of other debtors and impairments to bad debts, this is an actual measure of how much real cash is required to support trading and operations. Now, Paperlinks' performance on this pure trade working capital metric has been very poor. Over the past year, trade working capital has deteriorated, absorbing $23 million of cash, which could have otherwise been used to repay debt or fund restructuring. If we take the 2012 trade working capital to sales ratio, that is 18.6 cents required working capital to support each dollar in sales, and if we maintain that in 2013, Paperlinks would have been able to realise $63 million of free cash from trade funding. By comparison to world's best practice, a company like Amcor, which incidentally spun out Paperlinks many years ago, has a trade working capital ratio to sales of only 9.8%, as contrasted to Paperlinks' 21.9%. Viewed differently, this means that Paperlinks' cash cycle is over twice the length of Amcor's, taking 80 days in comparison to Amcor's 36. Now, if we go and apply Amcor's trade working capital management prowess to Paperlinks, and if they could do it as well, Paperlinks would be able to liberate $320 million of free cash from working capital on its balance sheet. Now, the second key issue we've identified from disclosure is surrounding risk. Now, if you go down into note 31 and look at the detail in there, it states that the company policy is to target between 40 and 60% of their debt exposed to fixed rather than floating interest rates in order to mitigate risk. We find that as of the 30th of June, the entire $229 million debt balance is floating rate, leaving Paperlinks naked if interest rates move adversely. The company disclosed, quote, "The board exempted the consolidated entity from undertaking interest rate hedging for a period of 12 months, unquote. No explanation as to why it was given. Now, this is very unusual because there's always much more risk if interest rates rise or move adversely rather than favourably. At the current average interest rate of 4.4% and interest rates in the UK and Europe at multi-decade lows, there tends to be a perspective that there is only one way rates can go from here. And why would you want to be on the wrong side of that? Further, we identify a significant risk in terms of the GBP-AUD exchange rate, which has increased 10 times. Note 31 also discloses that there is a 71.2 million Australian dollar exposure to the British pound and a $10.6 million profit sensitivity to a 10% adverse move. This compares to a reverse $1 million move sensitivity last year. Now this is unhedged FX risk, and that was essentially currency speculation. If the British pound rises against the Australian dollar, it'll pay off. However, if it goes the other way, it will magnify the losses in the region. Now both these instances in terms of foreign exchange and interest rates demonstrate risk-taking behaviour, which is not a responsible activity for the board to be engaging in. I'll now hand over to my colleague Simon Odom, who will cover a bit more detail on the financial forensics.
Thanks, Paul, for that summary. That was excellent. One of the things that you understand when you look at a few different types of businesses is that there are basically bulk commodity businesses and then specialised businesses, and each of those tends to have their own types of margins. So I'd like to talk about four separate things. One is the margin analysis for paper inside of PaperlinX's divisions, credit risk insurance, the major concerns in the FY13 accounts, and more evidence of the requirement to recapitalise this company. So overall, the EBIT margins for PaperlinX in Europe and the UK, you would think that would be fixable. However, unfortunately, on slide 28, we actually see that PaperlinX has been selling raw paper, its bulk commodity, at a loss for at least the last 3 years, perhaps longer. So what we've done here is strip out the revenue and gross margin of the specialised product signage and packaging businesses, which were disclosed after 2011, and then got an implied EBITDA for raw paper for the last 3 years. So we've gone from basically break even to minus 12.5% loss. Why would that be? In Canada and the USA, we've done a similar thing, and you can see that, as Paul mentioned, after the sale of the USA asset, Canada looks to be fixed. So that is positive for the medium term for PPX. For Australia and New Zealand and Asia, this actually gives a real indication as to what the underlying performance and what people should expect if Europe can be fixed as to the future of PaperlinX. So about 1.15 to 1.4% in terms of gross margin on paper, EBITDA margin on paper, and then the rest of the business, namely specialties, signage and packaging, is circa 15 to 20% gross margin. So unfortunately for investors, pre-2011, PaperlinX didn't break out margin for the specialised parts of the business. So historically, PaperlinX has also given tonnage by region, by geographic region, and we know that paper prices are priced off pulp, which has increased circa 12% over the last 12 months, and yet PaperlinX's revenues went backwards. So that tells you that it lost market share in every region. One of the things that's a little bit concerning when you read the accounts, if you're either an ordinary shareholder or hybrid holder, is that the inventory days increased from 38 to 42 days. Trade debtor days increased from 71 to 79. Given that PaperlinX factors receivables in about half of the business, this is most unusual. As Paul explained earlier, the cash cycle, i.e. from actually selling something to collecting the cash, increased from 68 days to 80 days. That is, again, most unusual. So the other thing that is a little bit concerning is that they've talked now for 18 months, the company, on the company's growth strategy. Again, almost nil disclosure. Note 31 in the accounts concerned me, and I'll quote, "In a number of jurisdictions, the consolidated entity has credit risk insurance to mitigate its exposure to doubtful debts. Given the difficult trading conditions within the paper industry, the consolidated entity cannot guarantee the availability of this insurance in the future to the levels previously provided by the external insurers." What do these major concerns actually mean? PaperlinX sells a bulk commodity in a high turnover, low margin business. PaperlinX is required by its suppliers to carry credit risk insurance. Should PaperlinX be unable to secure this insurance, it is possible that the major mills would stop supply to PaperlinX. Next, PaperlinX has not addressed the other areas that suggest PaperlinX will not return to profitability, namely the cost of factoring receivables and financing the inventory in Europe is greater than the profit margin than they actually make on the sale of its bulk product. What this suggests is that PaperlinX will continue to get smaller to try and get out of the hole that they have dug all by themselves. The next issue that needs to be thought about for FY14 is that there are many drains on this cash, and this highlights some of the reasons as to why PaperlinX, first of all, needs to fix its balance sheet and then needs to recapitalise the business. For the defined benefit pension plans, that increased by 20 mil, even though the discount rate increased. Cash commitments for FY14 are expected to be largely in line with the prior year, 18 million in cash. PaperlinX has now established a team in Shanghai, China to focus on sales and global procurement. Is this a backup strategy if the major mills in Europe were to stop supplying PaperlinX? Finally, PaperlinX announced further restructuring in Germany, the UK and Netherlands, and the potential restructure and or sale of its delivery company. However, there was no guidance on costs or additional asset write-downs in FY14. Finally, in the accounts, PaperlinX had $87.7 million in cash, but the available unrestricted cash of 13.9 million at the end of June 2013, which if you read the next note direct from the accounts, shows you that at present, PaperlinX doesn't have sufficient cash to fund all of the obligations above. So it's pretty clear that there's going to be a multi-step process to fix and repair PaperlinX. And now I'll hand back to Paul.
Thank you, Simon, for that insightful analysis. We now move to a new section of this webinar, and this is just given along with PaperlinX's FY13 results. An announcement was also made regarding the fact that PaperlinX is now in discussions with Morrison Company and the Trust Company as responsible entity for the PX UPA SPS LLC Trust. that they are considering converting the PXUPA into PPX ordinary shares. And we've called this the potential scrip offer. The discussion here will take part in 4 parts. First, I'll give you a bit of background on the potential scrip offer. Then we'll go into an example of how to calculate the value per PPX and PXUPA units. I'll then cover a slide that shows you a ready reckoner to assess the offer value at different conversion ratios. And finally cover off on a couple of issues to consider when evaluating a prospective offer. Also important here to note is that the calculation of PaperlinX's current combined market cap of $68 million as of close of trading yesterday is based on those prices. So that's 609.3 million ordinary shares at 6.5 cents each, plus the 2.85 million hybrids on issue at $10 each. And the values in the ready reckoner are also based on this data. By way of background, last week along with its results, as previously mentioned, PaperlinX announced its negotiations with the RE, with the SPS Trust regarding a potential offer to exchange PXUPA units for PPX shares. If an offer is made, each hybrid holder will have to carefully assess its value because, as we have demonstrated previously, the RE cannot be relied upon to act independently. The realised value per PXUPA hybrid depends on 3 key factors. The first is the conversion ratio of ordinary shares offered by PaperlinX per PXUPA. The second is the value of any sweeteners offered by PaperlinX, which could take the form of cash, although it's unlikely, options, or some other type of note. And third, the resulting uplift in PaperlinX's market capitalisation, which is seldom properly understood. The following slides will show you how to evaluate a scrip offer and explain using an example scenario. After that, we'll also be considering the issues to take into account in deciding whether any prospective offer is fair and reasonable and whether or not you should accept or reject it. Okay, you'll see on this slide here a lot of numbers and letters in quite a few colours, but we'll endeavour to simplify it for you. There's a 2-step process involved in calculating how much an offer could be worth per PXUPA. The first step is to calculate how many PPX shares will be issued post-conversion. To do this, we multiply the conversion ratio, that is, how many PPX shares PaperlinX offer per PXUPA, by the 2.85 million PXUPA on issue to get the number N. We add this new number of shares issued N to 609.3 million PaperlinX shares already on issue to get the new number SI. For example, if the conversion ratio were offered 500 PPX per PXUPA, we'd have 1.425 billion new shares issued, and if we add that to the old number of PaperlinX shares on issue, we'd get about 2.03 billion shares on issue. We then take this amount and use it for step 2 in order to calculate the value per PXUPA based on the resultant uplift in market cap. Now to do this, we take the expected market cap after the liability has been removed and divide it by the new shares on issue. So for example, if we conservatively assume that by removing $285 million in liability, which is what PXUPA is currently on the balance sheet, and if we assume that that will lift the value of PaperlinX by $82 million from 68 mil, which is their current market cap, to 150 mil, that 150 mil becomes the new VEC. So we take that 150, divide it by 2.034 billion shares on issue, and this gives us 7.4 cents, which is the new price that PaperlinX would trade at, or NP in our shorthand there. We then take this value NP and multiply it by the conversion ratio, that is how many shares each PXUPA gets for converting, and multiply that across to get $36.87, which would be the effective value realised per PXUPA. Now we've presented this information in a ready reckoner table on this slide here. So the 2 key questions are in the blue box above, what happens to the PPX share price if all hybrids are converted, and the brown box below, what will be the realized value per PXUPA. Now the light blue and light brown data points in those cells are effectively the prices for both classes of security if a deal were to go through. Now as you can see, as the conversion ratio increases from 200 to 800, ordinary shareholders experience a more severe dilution. And by the same token, hybrid holders receive more value as their share of the company increases, as reflected in the black row at the very bottom. On the vertical axis, we see different assumptions on market uplift. So if we were to assume, for example, that if you take out a $285 million liability, nothing happens to the market cap, you'd get the top blue row there. However, if we assume an upside scenario that the market cap lifts to $250 million, which is still less than the whole liability that's being removed, you can see, for example, at a 500 times ratio, PPX ordinary shares would be worth 12.3 cents, and the hybrids would attain value of approximately $61.45 per hybrid and hold 70% of the company. Now that's a bit of a complex table, so we've presented the information in another form on the next slide. So this chart here essentially shows the relationship between how much of the new company is owned by each class of shareholder based on different conversion ratios. And there are three key data points on this chart representing the bounds and perhaps a fair value for what kind of conversion ratio could go ahead. At the very low end, if we take the market prices of PaperlinX ordinary shares and PXUPA hybrids as of yesterday, the market implies a ratio of 154 ordinary shares at 6.5 cents per PaperlinX hybrid at $10. However, at the opposite end of that scale, if a forced conversion were to occur at a 2.5% discount to the 6.5 cent closing price of PaperlinX, that conversion ratio would be 10 times as much. In effect, one hybrid would receive 1,578 PaperlinX ordinary shares, and the hybrid holders would end up owning 88% of the company. Now, as to the answer of what is a fair conversion ratio, the answer is likely to be somewhere in between. Now, we've picked a middle point here, and then we'll say that 794 ordinary shares per hybrid is what is a fair share ratio, and that's based on PaperlinX hybrids getting a percentage of the new company that is equal to their current share of net assets on PaperlinX's balance sheet. The likelihood of any offer below 300 times or 300 ordinary shares per PaperlinX hybrid is unlikely to get through, given the fact that the hybrids would need to take a large haircut and give up security. So covering two issues now. The first is what is a fair and reasonable ratio. Now, in addition to the information provided in the previous slide, we find that because PXUPA would have to take a 60% plus haircut at any ratio below 300 times and also be giving up their security and seniority, whilst ordinary shareholders would benefit from a doubling of the share price at the high end of the cap range below, that this is not a reasonable outcome. As previously mentioned, the upper bound to the ratio is 1,578 ordinary shares per hybrid, and this is based on a forced conversion of 6.5 cents less the discount. However, this would probably be disruptive to the business and is therefore not commercially realistic. And reiterating the same point again, the PXUPA to receive a share of the company equal to their 78.8% share of PaperlinX's current net equity on the balance sheet, the ratio would need to be approximately 800 ordinary shares per hybrid. Now, the second issue is considerably more uncertain, and this forms the second part of the value equation. So this is saying, well, if we take out this $285 million liability, we clean up the share structure, so there's a single class of shares on issue, what would the new uplifted market cap be? Unsurprisingly, it's going to be very difficult to predict what the new market cap would be under this scenario. However, we do have a few data points. The first is the $117 million offer made by a private equity player for PaperlinX in December 2011. Now, this was almost 2 years ago, so the operations and the profitability of the company have changed since then. However, it may still be a useful data point in assessing any potential uplifted market cap. And the second would be to apply a conservative EBIT multiple, for example 5 times earnings, to sustainable revenues of circa $2.5 billion on a long-term EBIT margin of 1.5%. Now if we do this calculation, so $2.5 billion multiplied by 1.5% on a multiple of 5 times, it gives us the result of $187.5 million. So that could potentially be the new PaperlinX market cap under a collapsed capital structure. So in the event of corporate activity, the new market cap is likely to be in this range above. However, there is upside potential given how much the European and UK divisions could earn if they are properly fixed. I will now hand back to Graham, who will give some closing remarks and open the question and answer session.
Thanks, Paul. That was excellent, and I can see we've got a couple of questions here, but I think they've been answered by your very detailed explanation of the uncertainties and the high and low ranges. What is a fact is that it's no surprise that the PaperlinX hybrid is fairly strong in the market at the moment, because it's clearly apparent from what both Simon and Paul have said that something needs to be done, and something needs to be done pretty soon. So I'm not going to answer those questions because I think the questioner will have been satisfied by what Paul has said.
Sorry, Graham, I might just interject for 1 second there. So we do have one asking what voting threshold of PXUPA holders is required to pass the upcoming scrip offer. Now, from memory, that is a special resolution, so that would require 75%. And based on the premise that PaperlinX need to remove the whole hybrid and not leave any outstanding, they'd need to get to that threshold for it to pass.
You're right, and I missed that when I was scrolling down. There are no other questions. Let me just close by being perfectly frank with you as a significant holder of the PXUPA hybrid. As most people know, Gabby Berger, who's also on our committee, he's certainly in the top 10. Last time I looked I was, but the nature of the register has changed, and but I still think I'll be in the top 15. What we do know is that recent initiatives by the board may have been caused by Webinar 1 or major credit providers to PaperlinX upon publication of its 2013 accounts, or it all may be just a coincidence of timing. We'll never know, but I'm sure that Webinar 1 caused some ripples, as we, those who host this webinar, know who the attendees were, and they included major suppliers to PaperlinX, particularly in the UK and Europe. Let me be very clear about this. We all want PaperlinX to succeed, as the alternative paths are messy and there are unascertainable risks for everyone. I also stress that our comments and commentary are based on truth, not spin, and have never been credibly challenged by anyone. Some people choose to describe them as negative in order to discredit us as part of the divide and conquer campaign. The commercial reality is that everyone who needs to know about PaperlinX is fully aware of the problems at PaperlinX. the major suppliers to PaperlinX will know far more than anyone else. Excuse me. We believe and feel totally committed to inform the ordinary and hybrid holders of their potential futures. Otherwise, professional spin and shareholder apathy, not rational debate, will win the day. Unless recapitalisation occurs immediately, and I truly mean immediately, PaperlinX could easily fail sooner than most people imagine. This is our strong belief, and it's been demonstrated today by detailed analysis of the figures by both Paul and Simon. We submit that ordinary shareholders have been in la-la land, and they are now realising this. It's time for some hard ethical decisions at the board level. Gentlemen, I suggest you start by looking beyond the street light. That's all I've got to say, and there have been no more questions, so I bid you a good evening from Melbourne, Australia. Have a happy evening or a pleasant day in Europe.